right. Hi, everybody. Buenos dias. I'm Edward, co-founder of Staking. We're a Web3 infrastructure provider and non-custodial staking service provider, and I'm very excited for this next panel with three great panelists on the last 30 basis points, who really owns the yield on tokenized RWAs and on-chain DeFi yield products. How about we start with a short round of intro? Ryan, would you like to go first?
Sure, yeah. Hey everyone, Ryan Haczynski. I am the head of protocol partnerships at Global Stake. We are an enterprise-grade, institutional-focused bare metal blockchain infrastructure provider. Only run fully on bare metal, don't do anything in the cloud. SOC 2 Type 2 certified, and really focus on institutions. And looking forward to today's chat.
Hi guys, I'm Amadeo, co-founder of YieldNest. YieldNest is a DeFi structured product platform where we combine different yield opportunities from RWA yields, restaking to DeFi yields, and package them in creative ways.
Hi everybody, my name is Lorenzo. I'm one of the co-founders of Colossus. Colossus is a company that's actually changed quite a bit. We started as a validator, then due to necessity we became a custodian, and now we're neither because we've created a platform that basically connects these two worlds, and I think that that's what we'll be discussing today.
Thank you guys for the intros, and very happy to have you here. We have different profiles and different companies from yield generation, yield packaging, and also the execution layer connecting from that issuance to the investors. I think it's a good time to tackle this topic. We've seen trillions of dollars of RWAs on private enterprise chains, but also billions of dollars, I think 30 billions or so in on-chain assets under management. Out of this, probably 10 billion or so is RWAs as well. And I mean, with this comes my first question to this panel, and it's who actually, owns the yield that's generated from all these assets, who's extracting that yield, what are the different users, intermediaries involved on that yield value chain and benefiting from that yield. Maybe we can go from my left to right. Ryan, if you want to share a few thoughts first.
One would hope that the main benefactor is the end user, right? I mean, you want to be using these RWAs and tokenized assets in a way that can not only earn the yield that is packaged within them. I work very closely with the Centrifuge team, for instance, because of my work at Global Stake, and they've done a great job with a lot of their tokenized assets in terms of structured credit products. They were the first ones to put RWAs on chain, and hopefully that value does flow down to the user, because you want to be able to deploy these things as collateral and then earn the yield on top of it, and then still put it into DeFi.
All right, thank you.
Yeah, I think it's very important that when we structure these new RWA products, that we're not creating new middlemen. So I think we need to make sure that we get pristine collateral on chain and get the yield from that source and connect it to the DeFi world, so that, and to the user at the end of the day, that the user earns the most and not the middleman, or not that we're not tokenizing the wrong things, that we're not tokenizing junk, or that we're not tokenizing things that don't drip real USDC or real USDT on chain. And I think if we follow the principles of DeFi, where like lending markets or liquidity pools, everything is transparent. You can see the liquidity, and I think it's important that the users can see the yield flowing in and can see exactly how much yield flows, and transparently how much of that, for example, goes to a certain fee splitter, or how much of that goes to the end user. I think it's important for us as an industry to always try to highlight that and make sure that we can remove middlemen and we can make better products on chain, and then we can win.
Well, I'll take a bit of a different approach. For me, the whole point is that you start from a fact that is there is only about 13% of the assets, institutional assets that are in custody, are generating yield. So, I think that the real topic is how do we unlock that capital? Because there is a big unlock to do. So, there's definitely interest there. When we started, the yield course, everything that my fellow panelists are doing gets more and more interesting, but the issue is how do these companies interact? Because if you are locked, you know, in the bad sense of the word, inside a custodian, which of course makes security out of its business, then the point is, why should they be deciding what you can and cannot do, and who you can do it with? Because no bank in the traditional world tells you, yeah, but you can only keep pounds and euros, no other currency. And these are the two banks that you can send your assets to. That's kind of the situation that we're in. So I think that who owns the yield, definitely, you know, the yield should be, and it should definitely go to the end users. And, you know, from where we stand, the end users will be institutions more. But I think that the concentration that we all need to do is in growing that pie. Because there is a lot of pie, and we should be able to unlock it. So let's work together, and that's the direction that we should be going.
Yeah, that's an interesting take. So indeed, yield is mostly owned by the user, institutions, but the real issue is actually that despite the traction, most of the assets are sitting idle. And all those sometimes centralized platforms are not offering the possibility to these institutions to benefit from the yield. Is this something you're also seeing probably like in the proof of stake ecosystem or on DeFi yield products?
Well, I mean, I think Lorenzo's point in terms of just the value capture from some of the larger QCs is definitely something that we're trying to avoid, but there's so much to go around, there's so much value to be transferred, and I feel like that's just the ability to find that unlock is going to be the most essential thing moving forward, because we're very early in all of this, right? Tokenization is an end game that's going to take probably years before we really get to where everything is fully on chain, and we get that level of transparency that one would hope, you know, to keep those DeFi principles alive and have that ability to be able to source all of it, find it, and I think a lot of that's already starting to happen because of the types of oracles that are being developed, where we can kind of see what is happening off-chain versus on-chain with these, So I think as the infrastructure continues to develop, we're going to see more of that value unlocked across the entire spectrum.
Yeah, I would agree with that. I think it's indeed very very important that kind of hammering down on the transparency side again, like if you loan money to a RWA asset, or if you loan money in general anywhere, if you don't really understand where the yield is coming from, you are the yield. So it's really important that you know for sure that, oh, I lent money to this instrument or this packaged product, and I can see clearly if something would go wrong, there is a certain security or a stick that if the yield doesn't come back, there is some an instrument that we can just use to get the principal or the yield back, right? Because when I look now at the RWA landscape, a lot of the RWAs are factoring or unsecured loans, which basically means you don't have any recourse if something would go wrong. And of course, it's a very difficult topic because, like, if we have a lot of recourse, there might be KYC, AML blockers around the product. That's also not good, right? That's also not what we want. So I think we need to find the middle ground while still having that freedom, but also having the clear, pristine collateral that we can see, like, hey, if something goes wrong, we do have a stick to get the off-chain issuer to give back the money.
Yeah, that touches on an important point, right? Yield, I think transparency or opacity around this yield generation sometimes sounds like we may be recreating sometimes. How do we ensure that there's actually transparency along the value chain? Can we track everything on chain? Can we have like clear reporting on all this value chain from like?
I would say like TLS signatures. So if we can like off-chain like proof, for example, with land registries, for example, at YieldNest we release a new product, Wine RWAX, and we have mortgages that we control. And if ever something goes wrong, those mortgages can be liquidated. And you can prove that you hold the mortgages via TLS signatures, with the API registry for the land register, for example. So these kind of things are all very new, and they definitely need to be further explored and implemented. And then I think we can have the assurances of actually better. I think we can have better assurances on chain than assurances off chain with some, non-transparent legal contracts, which are very hard to understand. But if you have TOS signatures and if you can prove that those, not just the legal proof, and actually a hard-coded kind of proof, then that's...
And that should be, sorry to interrupt you, and that should be really the aim of what we do, because we're coming from a world where we would be happy to just look at it on a PDF. That's how,
it's kind of,
everything's been working. No? So now you have the PDF, and you should have something else that makes it traceable but understandable. Because one thing is, how is your counterparty going to be understanding this? So this needs to be explained, and there needs to be a clear audit trail. Because if we are, again, I'm always coming from that angle, but if I come from that angle, that means that there needs to be a clear, the data needs to be clear, it needs to be on-chain, but it needs to be downloadable because it's going to have to go inside the open banking standards of the bank that's going to be using that, that's going to be interacting with those products. And so I think that's a big unlock again, because that's going to be giving more confidence. And that's what we're all about, giving confidence and making sure that the access to these products is simple, because I think that at the end of the day, the CFI, as in the custody, needs to speak to the DeFi, which is the yield. And so these are the two worlds which, in a way, definitely not colliding. They are, they are merging, working together and merging more and more. And that's exactly what real-world assets is. That is transferring all of that onto DeFi or onto the blockchain. And
I think we actually have
that there's more data now.
Exactly, and I think we have a very big opportunity to actually do it much better than actually we can add value to the TradFi world with these proofs, and DeFi can earn more money can gain value from getting more real yield sources, and not just food farms or something, but real yield sources, and then we can add value back with real proofs, I think.
Yeah, I agree.
Yeah. I mean, just complementing what they said, I think we need to just have the best of both worlds, right? I mean, at the end of the day, we should have a world in which the standard accounting practices that we demand from TradFi come on-chain, right? So whether it's GAAP and all these other things, and being able to, your point, trace all this in a very transparent way, have Dune dashboards that are up to date, and not just in a quarterly way when we're expecting a PDF where we can see, oh, this is what happened over the quarter. I mean, we have the ability, when we have all this on-chain, to see it second by second and see these things update in real time. As I was saying, some of these infrastructure pieces come into place, like oracles and everything else, and we have that verifiability. I think that all of this, all this is going to fall into place.
Yeah. And I think that, to your point, some of the, I mean, if we consider again that most of these transactions are starting from a custody environment, most of these environments do not have that kind of data. So they rely on external sources. So that means that you end up using lots of platforms, which is something you don't want to be doing. Because if you're managing large sums, and of course you want to be differentiating risks, so many providers and many protocols, and that again becomes a nightmare of management. And so that's why middle layer platforms, which are going to be out there, we're not just talking about us, but I mean, there's going to be others, of course. That's where the value is going to be, because you're going to have orchestration layers. So I'm going to use more than one environment. So from the security point, I'm going to use lots of protocols and lots of providers. And all of this needs to be in one place so that I can monitor it and understand what's happening to my customers' assets, probably.
You don't own the yield if you can't verify the yield, both on-chain but also with transparent reports that matches TradFi institutional grade accounting standards. And it sounds like all of you guys are doing a lot of efforts in that sense. But I mean, beyond transparency, because I imagine we can have transparent yield where we can track how it's generated from like the insurance to the middleman, how much commission is being charged, how much the end user is getting out of that yield. But sometimes, even with all these best features available, we may still misprice the yield, or we may still get into yield products that ourselves don't understand or don't really control. What do you think of like, aspects regarding liquidity and risks around like some of those DeFi or RWA yield projects we're seeing?
When we're talking about institutions, at the end of the day, I think broadly speaking, sometimes in our space, we use that word a little too easily. We throw it, we think institution, large capital allocator. The reality is, when you think about these TradFi giants that are coming to this space, first and foremost, they care about, risk, and then it's security, compliance. Yield is going to be down. Of course, it's going to be important, but I think that they have to take those three into consideration. So at the end of the day, it's going to require a lot of due diligence on the part of these institutions as they come on chain and they want to deploy and get into the digital asset space. So I feel beyond that due diligence, it's going to be a matter of all the things that we were just talking about previously. The more we can put that transparency on chain and show that verifiability of these assets and have multiple audits, I think that's another thing you can look for, is that the best teams out there are always going to ensure they have multiple third-party audits for whatever they're bringing on chain, whatever kind of assetizing. So putting all that together is going to be, I think, the first thing that institutions are going to look for because to your point, that there's always going to be a risk, right, involved in doing anything, especially whether it's just as simple as smart contract risk. So I feel that's always going to be the most important piece, in just verifying that all of the building blocks are there necessary to actually earn a safe and steady yield.
I guess
I would also add to that yes, that's so the compliance to add the assets on chain, but I think it's also very important. And as I said, we need to try to merge the best of both worlds, right? Where TradFi can see they're very interested in Aave or Morpho or Euler, that's cool, right? And we need to see if we can take these pristine RWA collateral on chain, and then in a way kind of merge that with the DeFi, with the real DeFi philosophy of having permissionless access and permissionless assets going in liquidity pools or lending markets, and using those DeFi tools to the max while also bringing that real yield. So, for example, now with YieldNAS, we have our kind of first RWA asset that we released, but it has a 1-year coupon, right? So that's a 1-year lockup on your vault, right? How do we solve that? Well, there's creative ways in DeFi that we can tranche the durations or calculate a yield curve where you pay a little bit of slippage if you exit the product. So these things, we can all program these components on chain, and I think in a lot of these instruments, normally in TradFi, it's really difficult to do that. One, regulatory-wise, but also just from a management perspective. How do you manage off-chain? You have a fund, you have a fund administrator, and if people want to leave or enter, you have time series, and you need to talk to all these people. But if we have a decentralized ledger where we can put these assets on chain and people can just interact with it, and people can actually also see themselves, I can poke this RWA contract and I can actually get my underlying assets back, and I can see the assets are there, and I can actually interact with it. I can put it into a curve pool, I can put it into a lending market, and I can make it fungible. I think that is going to improve these liquidity issues that we're now having with the RWAs. And we do need to find a way to structure these RWA products in a way so that they can live freely on chain. And I think we have a way to do that, and I hope to see more RWA assets just merging in with DeFi. And I think the liquidity of these assets will improve over time.
Slightly different approach, but just agnostic on protocols and providers. But what's happening is that the questions that we're asked, want to access certain yield opportunities, is how is it segregated, KYB, sanctioned list on the other side, because there are rules and regulations which make that interaction very complicated. And so the more we structure that, and of course take the best of the DeFi world and making it more efficient, and composability of different yield, but there's probably needs to be certain verticals that are created, or specific products which are targeted taking the best of both worlds, of course, but starting from the requirements and regulations that those companies need to abide to, because otherwise we're just going to have issues further down, and that's going to, I think, penalize all of our markets. So I think that the more work we do beforehand, the better it's going to be for afterwards for all of us. So that's my take.
Yeah, definitely. I feel like things are getting very complexified sometimes with all these different types of yields. So staking yield obviously is simple, is straightforward. You're securing the networks. Then tapping into like RWA yields, where we need to understand what the assets behind, and also sometimes if there's any synthetic incentives on tops. And then like on staking itself, then we have like obviously MEV yield that comes here to move the yields, block builder, like extra rewards on some networks. Each network is different. How do we kind of reconcile all those yields as an institution from like understanding which kind of yield we're getting into the vaults from staking, looping strategies, RWA strategy, when synthetic yield, when everything gets all mixed up like that?
No, I think it's like, well, I think stacking these yields is actually kind of cool, because that's never really possible in traditional finance. But now in DeFi, we can actually have indeed a structured product that also captures the trading fees of the underlying derivative in a one product itself that is again a derivative of itself. You can go really crazy with the composability, and the design space is quite vast. And I think it's a good thing as long as it is transparent and as long as the accounting is on chain. I think the problem happens when you have virtual balances. We have seen that recently with a couple of protocols in DeFi that had virtual balances, and that's also, I think with RWAs, it's important that they inject their yield not just in a virtual update of their NAV, that, oh, now the price is this because of X, Y, Z. It needs to, in my opinion, these assets will need to drip their yields on chain if it's possible. It's not possible all the time, obviously, but if we do that, then actually the yield that you can see, it's not that complicated, because you can actually always build it from source, and you can see, oh, where's the yield coming from? You can see on chain exactly where what's happening. And
is on-chain yield sustainable according to you? Are we like earning, sustainable yields, or is it mostly made through like synthetic rewards right now?
Oh, you mean it's the DeFi yields?
Yeah.
Yeah, the DeFi yields need well, I think traditional finance needs DeFi, and DeFi needs a little bit of RWA yields, so from off-chain, from mortgages, or from different economic activities, and I think they need each other, in my opinion.
Yeah. And once everything will be compliant, are you working on integrating any RWAs at Colossus?
Well, we definitely are looking into the possibility of connecting into yield opportunities that are approaching that. Customers are absolutely asking for it, so that's we see that as the next big thing for sure. But even going back, because before we were saying about how simple staking revenues, and I would disagree in a way, because for example, there's different protocols, and you have the rewards being given by the hour, by the day, and all of this. When it goes back into the reporting, that some of these, thinking about banks, because there's still design and product to be built on the receiving end. But again, coming back to your question, as the one big thing that's coming. Seeing how this unlocks a lot of this capital, which is in these institutional investors. So we'll see that in the near future.
I mean, ultimately, I think of the word simplify. I mean, it's when we're coming to the space and it's about educating them. The world that you and I know, of course, as staking service providers, right? That is very easy to explain. Lock up, you're going to earn a yield for security. Through some of the issuance of the token. I think when we get into RWA, simpler and more straightforward the product is, the easier it is for them to understand. So going back to example, closely with what they've deployed since winning the Biddle Prize, you know, it's treasuries. Like, that's something that every TradFi institute person understands. It's this simple way, okay, I'm basically just getting paid off the government debt. We see other things that are very simple, credit products. Nice is that because they are so easy to understand and you know what's under the hood, so to speak, I think build safety for them to feel like, oh, this is a sustainable yield that can be used. And what's nice is, you know, getting back to the previous question about liquidity too, it's that you can find these products, these structured products that are issued as RWAs across multiple chain environments. Like they trade on, you know, Aerodrome, Solana, so on and so forth for some of these DE RWAs that Centrifuge has, and you could get a 4.7% yield on a structured credit product, but then you could still turn around and use it in DeFi and have it as, you know, structured, you could use it collateralized alone through a Morpho vault. So I think the easier you can make it for them, the more that they'll feel comfortable coming into the space and using a lot of these different yield strategies.
How do you see this bridge between TradFi and DeFi evolving in the next years? Are we going to see more complex products also emerging? Are we going to focus on structured credits and more simpler products?
I mean, I think it's a matter of, as one of my co-founders likes to say, you know, crawl, walk, run, right? We're still very much in the crawl stage. I don't feel that we want to necessarily make things inordinately complex at this stage of the game. It should still be trying to keep it as simple as possible, and then maybe working toward that walk stage where we do start to, for the more, you know, the users with expertise that maybe have more, you know, they're more savvy when it comes to using DeFi, because I'm sure you guys have seen this in your own work, in your own protocols. There's a range of people who are engaging with your product, right? And you may have somebody who's just, I'm a button masher. I like to be a DeFi dabbler, so I like to just try things, and it's just in my nature. Some people aren't like that. They need to have their hand held. So I'm curious to see how this evolves over time, but I feel like it'd be best to just take it slow and steady, because we're at a point where settlement seems to be the end game that people are always worried about when it comes to RWAs. But as we were saying earlier in our talk, the more that we can make this seamlessly integrated to where you can get stats up to the very second on a Dune dashboard, the easier it's going to be to get everybody to come in and use these products.
Thank you.
Yeah, well, I absolutely agree, and I think that there's going to, you know, the need of hand-holding is very important. So, for example, we also do a bit of a white glove service where we support our customers in creating and, you know, physically executing the transactions together with them. That's definitely something that I think is going to be more and more. Then the other thing is, I don't really think that we need that many products, because we've got tons. You know, we have more products than we need. We just need adoption. And so I think that we need to work more on the, you know, getting people, you know, allowing them to interact. Then, of course, there will be other products. But I think, you know, as always, it happens that first we're doing the product, and then we're looking for customers. You know, usually, it would be the other way around. You should first have, you know, customers looking for something, and then that's how you execute. We're, of course, in that market because it's innovation, it's tech, of course, and you're always trying to predict where the market is going. And the interesting thing is we're doing those predictions starting from what's already happened in traditional markets, but just making it better, utilizing DeFi, utilizing transparency, you know, being decentralized, all of that. And even, and again, talking about the decentralization, that's another ethos that we need to maintain. Because by centralizing everything, we're going exactly in the opposite direction, which we don't want to do. No. So that's my closing thought.
I think settlement assurances are very important, and I think still, like, if they want settlement assurance are kind of like the 4A instrument that you can move on chain. It's like the hardest, but you can also have other settlement layers, whatever the institution like prefers. And I think it's important to build very simple products, but to always keep in mind that we always want to show the transparency on chain, because we built all these decentralized ledger infrastructure to show transparently what's happening, and I think that's important. And maybe, yeah, we want to show transparently where the yield is coming from, but at the other hand, with indeed these TLS signatures I was talking at the beginning, we can prove collateral via zero knowledge proof. So we can we can actually make a very simple product on the top and make it kind of complex on the back end if people want to dig deeper, so that everybody can dissect the product, but make it very simple. It's a very simple interface that everybody can just break down, in my opinion. Yeah.
Thank you, guys. I think this concludes our panel. Thank you for your words about transparency and making great products on DeFi and RWAs that are institutional grade.
Thank you.
Thank you so much.